The new Fed chairman was sworn in at the White House, not at the Federal Reserve. That small detail may end up telling you more about the next decade than most economic forecasts ever will. Because markets do not just react to policy, they react to confidence. And confidence is starting to shift globally. Right now, investors, operators, governments, and institutions are all trying to answer the same question. Can the Federal Reserve still control inflation without breaking the system underneath it? That uncertainty is already changing how sophisticated capital moves. Most people just have not noticed it yet. The Fed inherited an environment already under pressure. Persistent inflation, elevated energy prices, mortgage rates still limiting affordability, historic debt levels, global instability, and consumers becoming increasingly stretched financially. This is no longer just an economic cycle. It is becoming a confidence cycle. And confidence is what modern financial systems actually run on. The repositioning has already started. Foreign governments are quietly reducing exposure to long-term U.S. debt. Central banks continue buying gold. Large corporations are preserving liquidity while raising prices to protect margins. Consumers are delaying major purchases. At the same time, experienced investors and operators are repositioning toward cash-flowing assets, productive businesses, infrastructure, essential services, strategic real estate, private lending relationships, and businesses solving real problems. This is not panic, it is positioning. And positioning always happens quietly before headlines catch up. The next phase of this economy will likely create two very different realities at the same time. People with productive assets and strong cash flow may continue building wealth. People dependent entirely on wages or unstable debt structures may continue losing purchasing power. That gap may define the next decade. If rates stay elevated, borrowing becomes more expensive. Banks tighten. Weak businesses struggle. Commercial real estate continues feeling pressure. And operators built entirely on cheap debt start getting exposed. But disciplined operators often find opportunity during periods exactly like this. Because when money is no longer cheap, positioning matters more. If rates drop too quickly, inflation pressure may return. The dollar may weaken further. Hard assets may appreciate faster, and real cash-flowing businesses may become even more valuable. This is why many experienced investors are no longer asking, "What will the Fed do next?" They are asking, how do we position intelligently regardless of what happens next? That is a completely different mindset. This environment may reward disciplined operators, businesses that are system-driven, operationally efficient, and relationship-oriented, cash flow focused, adaptable, and solving expensive problems. The next economy may not reward hype. It may reward infrastructure. It may reward discipline. It may reward operational strength. And it may reward people who understand how capital actually moves during uncertainty. Here is the reality most people do not want to hear. If a business only works when money is cheap, the model was probably weak. If one difficult quarter threatens survival, the reserves were weak. If systems collapse under pressure, the infrastructure was incomplete. Strong businesses are revealed during difficult ones. Economic pressure exposes weaknesses, but it also creates opportunities stable markets rarely offer. The operators likely to emerge strongest are the ones building productive assets and operational systems, strategic partnerships, and recurring cash flow, not emotionally, structurally. The next decade may not belong to the people chasing trends. It belongs to the people building positioning, because uncertainty changes behavior. It changes where capital flows and what investors value. The question is not whether the economy changes. The question is whether your positioning changes before it does.